Hello. Hold on, let me check everything. All right. Can you guys hear my microphone? All right, sure. Okay. All right, so let's just start the webinar. Hi guys, good evening. Welcome to our webinar for tonight. I'm your host, Brian, and tonight we have a very experienced speaker with us. But before we get to his content, let's talk a bit about Phillip Capital and who we are and the services that we provide. All right, so this is just a disclaimer that this presentation has not been reviewed by the Securities Commission Malaysia and is not an offer or a recommendation to purchase or sell any investment products. This is only for educational purposes only. Hence, Phillip Capital Sdn Bhd or PCSB is not liable to any outcomes that may arise from you making investment decisions based on the content of this webinar. You are advised to seek advice from a qualified financial advisor pursuant to a separate agreement if you wish to purchase or commit to any risky investment decisions. All right, so just a bit about us, so Phillip Capital Sdn Bhd was incorporated on the 7th of October 1995 and is a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd. You may formally know us as Phillip Futures Sdn Bhd, and that's because we were primarily offering futures back then, but since then we've branched out and started to offer more products. So we are a trading participant as well as a participating organization of Bursa Malaysia Securities Berhad, and we are also a holder of the Capital Market Services license. All right, so we have 11 offices across Malaysia known as PICs, Phillip Investor Centers, and our headquarters are located in Kuala Lumpur. So if you are nearby any of these branches, you are welcome to drop by and say hello because we don't bite. Okay, so I'd like to take this chance to thank our clients for allowing us the chance to win multiple Bursa Excellence Awards throughout the years. Just as of recent, we won the first runner-up for the Best Retail Derivative Trading Participant Award, as well as the second runner-up for the Best Overall Derivative Trading Participant Award for 2022. So a big thank you, and we are going to give you the best support you can ever get. And we aim to offer you the best services you can possibly get. All right, so we have a wide global network. We are operating in 15 different countries, which allow us to have a wide global coverage. As you can see right here, we have through us, you are able to trade products across different exchanges like the CME Group from the US. You have Eurex from Europe, you have Tocom and JPX from Japan, and as well as SGX and the HKEX from Hong Kong. So any of the products that you want to trade on these exchanges, you are able to trade them through us. So we are your one-stop solution for trading. We offer multiple products such as futures, from index futures to agriculture futures to interest rate futures to the good old shares and stocks like local Malaysian shares as well as foreign shares like US shares, Hong Kong shares, and all of that. We also offer contract for difference such as the Bursa shares as well as NYSE share CFDs, NASDAQ, and US index CFDs. So if you're interested in any of these products, we do offer them in our brokerage. So we are an award-winning broker, and we also offer 24-hour broking and execution support. We offer advisory services, as well as the latest market news, a wide array of products, as well as a really simple online account opening process. So you can learn with Phillip Capital. We offer free one-to-one coaching sessions, as well as a consistent stream of free seminars and webinars, as well as a free account opening process. So for the free one-to-one coaching, we basically have product knowledge, which will basically bring you through an introduction to futures, CFDs, and stock trading. And we also have the charting system, which is essentially us teaching you how to navigate our platform, also known as platform coaching. All right, so if you're interested in joining our upcoming seminars and webinars, do scan this QR code to register for those events. You can take a screenshot, or I could just wait for 5 seconds and okay, so let's move on. So we have weekly market calls as well. We have the market reviews and updates, which are conducted every week, as well as the live counter technical analysis, which is done by our research team. So if you're interested in joining any of these, just scan the QR codes and you can register for them every single week. All right, so if you're interested in opening an account with us, this QR code is for you to scan, and you can enjoy a hassle-free online account opening process to take your first steps towards trading success with the capital. All right, so here we have our section for the trading platforms. This is Flipnova, which is the platform our clients use to trade futures. We have a lot of good things like over 90 technical indicators and live market news. So they are both, this is on the App Store as well as the Google Play Store, so you can get them there, no issues. Next, we have our stock trading platform, which is for foreign shares. We have Poems Global MY, and for local shares, we have Flip Trade. Both of them are once again on the App Store, on the Apple App Store, as well as on the Google Play Store. And for those interested in trading Flip CFD traders, for those interested in trading CFDs, we have the Flip CFD Trader. All right, now next to our good part, the promotional part. Who doesn't like promotions, right? So first we have trade and earn with Philip, which the more you trade, as long as you get the minimum brokerage, you can trade and earn up to 1,800 touch and go reload pin, as well as multiple other rewards. So do scan this QR code for more information. Next, we have the Discover and Trade Singapore stocks, which means that you are entitled a chance to win an iPad Pro and more if you start trading Singapore stocks with us. So this QR code has all the information that you will need. And next, we also have the promotion for the US index CFDs. So if you're interested in any of these, do scan this QR code and you can get all the information to assist you in your inquiries. All right, so now to our speaker profile, we have David Ng as our speaker tonight. David is currently a full-time proprietary trader with IcebergX Sdn Bhd, a local proprietary trading firm based in Kuala Lumpur. He has done extensive research and is well-versed in the commodities and indices markets, and he currently trades the Malaysia Index as well as the crude palm oil futures market. He conducts regular public seminars and webinars on topics relating to futures trading and has aided individuals to start their trading journey. In addition, he has also provided frequent market commentaries to local media such as The Star, Business Times, and The Edge in that role. So he is extremely experienced, and we are very happy to have him here tonight. Without further ado, I'm going to pass the mic as well as the presentation to David, and he can get on with the content. Enjoy.
Yep. Thank you, Brian, for the kind introduction. So just allow me just to do a quick sound check. Are you able to hear me, Brian?
Yes, we can hear you.
Yeah. Okay, that's great. And hopefully my slides is up. Okay. Let's just start. So just before I start, just like to thank Philip Capital Sdn Bhd for organizing this webinar. I believe if you have been trading the palm oil market, it has been quite an exciting period, given the fact that we have seen a couple of last year we have seen how prices has actually went as high as 8,000 ringgit per ton, and eventually now back to where we originally at for the past couple of months, which is about above 3,000 ringgit. So it's indeed a very volatile period last year. This year, I would say the first half, crucially, it's been quite a range market. So if you are someone that's trading range, it's definitely going to be a very good opportunity for you to be in the market. But having said that, doesn't mean that if you do a trend trading, CPO doesn't offer you that kind of opportunity. Nevertheless, I think with any circumstances, there's always opportunity for you to seek if you have the right tool and right framework in place. So just before I start, as usual, risk disclaimer. So the presentation material here is purely presented here today is purely based for educational purpose. Dabbling in futures market, as what Brian mentioned, it does involve a lot of risk. So make sure that you do consult with a licensed representative. And if you're new to the futures market, always equip yourself with more knowledge. Affiliate Capital offers a very good platform when it comes to education. So do delve in those resources before you kickstart your trading journey. So the agenda in the next half an hour or so, we're just going to cover a bit on assessing a bit of the factors that's actually affecting the palm oil market in terms of prices. Now, just to disclaim myself here as well, being a trader, there's a lot of ways to trade the market. A lot of times and oftentimes, a trader will always use technical tool or technical analysis as a way for them to gauge the market direction. For myself, I come with a background of understanding fundamentals first. Then over the years, when I become a full-time trader, technical becomes very prevalent. So I would say I'm actually pretty much in for both fundamental plus technical as a way for a trader to navigate the market. So bear with me if you are new to the palm oil market. In fact, I think fundamentals to a certain extent does play a role and is crucial when it comes to understanding price direction. Now, as with any other commodities, seasonality is always something that is useful for a trader. Now, doesn't mean that whatever happens in the past will tend to repeat, but all in all, seasonality gives you a pattern. So there's always a possibility or probability that a pattern may repeat itself, but you have to be cautious that these are all the past. Prices are always based on, when you want to understand prices, it's always based on the past. So there's a fair amount of degree of hindsight that's in place. So with that in mind, seasonality, we may always use seasonality as a tool rather than using it as a parameter for you to make your trading decisions. I would say that will be a bit to a certain extent it's a bit risky, because certain times there's always a period of time where prices doesn't follow historical pattern. So that's where we really need to be careful when it comes to seasonality. But all in all, it's helpful for a trader because it gives you a bit of insight as to which, assuming are we entering a period of low prices or are we entering a period of high prices, historically speaking. So I think that's a useful tool for a trader to have when it comes to trading the CPO market. Now, obviously, to make trading decisions, we look at technical. Now, I'm a trend trader, so basically when it comes to market showing you a bit of momentum, whether it's on the uptrend or downtrend, trend trading strategy will tend to be useful. So with this regard, I use Heiken Ashi, which is a very very important trend trading tool, which is a derivation of candlesticks, which I'm going to share more later part. And last but not least, regardless of any steps that you take, any approach that you go into the market, having the floor plan or having the trading plan in place is important and it's vital. In fact, it's actually keeping your survival rate high. So there's always a saying: if you fail to plan, you plan to fail. So I think same goes for trading. We really need to have a plan. So before you make your decision or you embark on any important trading decision, make sure you have a plan in place. So a plan for execution, a plan for taking profit, and a plan for getting you stopped out if the market go against you. So I think having a plan is vital and it's a must if you are someone that's new to the market. Now, just want to cover a bit of factors that affect CPO prices. Now, these are not ranked by how important of an impact is, but rather it's just some of the key factors that's actually affecting CPO prices. Now, we can't run away from supply and demand. It's basic economics. So whenever you have high supply, normally market prices will tend to be quite weak, and vice versa. If you have low supply situation and demand is good, that will push down stock levels. And market is very sensitive to stock levels. As long as when markets start to hear that stock levels are inching higher, that's where prices will have to be adjusted. So that's where, if you are trading the market, understanding the market dynamics or market balance is important. If we disregard the market balance or market dynamics, we tend not to we tend to not appreciate how the price is going to hit to a further trend, or it's going to be ranging in the market. So I think importantly that we need to assess the market based on supply and demand perspective. Now, stock levels is something that if you are trading a CPO market, prices are very sensitive to stock levels. So just today, if you have been observing the market, you probably have noticed that there's a few estimates that's pointing to stock levels is actually going to inch higher in the next couple of weeks or months. So that's what caught market by concern. So in fact, you look at it, market did came down from last week high. So I think that's something that we have to pay attention. So next week is usually the crop report by MPOB. So that is where it's crucial for us to assess whether the stock levels is actually inching higher or is probably going to be stuck in a range. So that's important for us to assess. Now weather is an important factor, and weather always have a long-lasting impact. Now the key thing about weather is that the impact on weather usually take about months, but the price will reflect quite immediate. So obviously the major enemy when it comes to weather is always the extreme weather formation, which is the El Nino and La Nina weather phenomena. So whenever these two extreme weather starts to play out, that's where you start to see prices tend to rally. So I think I would say weather is something we should watch out in the next couple of months, because there's a few developments on weather front which could be quite concerning if we don't pay attention. Now, crude oil is another important factor that support palm oil prices. Why a higher crude oil price is supportive is because CPO is also used to blend biodiesel. So with a high crude oil price environment, that will benefit CPO prices as well. Now, government policy is again something that is also important for CPO prices, because assuming if Indonesia were to implement higher tax, export tax, that will make Indonesia less competitive compared to Malaysia. So in that regards, Malaysia demand for CPO is going to be higher, and that will support BMD prices. So government policy would definitely have an impact. Now, royal oils, one of the most closely, if we're new to the CPO market, one of the most closely related oil markets that is quite close to CPO market is always the soybean oil market. So if you've been trading the palm oil market, you notice that when you have high soybean oil prices, it will also lift up CPO prices as well. So we're going to touch a little bit on that in the later slides. Ringgit strength obviously is also an important factor, but the key thing about this ringgit performance of late is that despite we're seeing weakening ringgit, which should be supporting palm oil prices, but sometimes the relationship doesn't really hold, which means that when you have weak ringgit, naturally you should expect that CPO prices tend to be stronger, because exporters or rather importers will tend to benefit when you have a weaker ringgit, because now CPO prices tend to be cheaper. But however, I think those relationship may not hold in recent times, because there's also other factors that's actually affecting CPO prices, which have a major impact. And last but not least, economic outlook. Again, these are all relating to demand, specific demand for CPO. Now, I'm just not going to touch too much on some of the certain relevant factors, but I'm going to touch on some of the key factors that actually affect commodity prices, especially for CPO. Now, if you just look at, if you've been trading commodities as a whole, you notice that last year was definitely a big rally we have seen in the market for commodities. If you compare it relatively to equities market, last year was really a commodity year. So whether you are trading crude oil or gold, or in fact CPO, you saw a big rally in most of the major markets. However, I think this year the scenario has changed. You look at first half of this year, commodities is now the underperformer. Now the equities market is the one that's performing better. So having said that, I think the major theme, if you look at in terms of market as a whole, is still the concern of inflation. With commodity prices starting to decline, I think that would definitely ease a bit of fear for inflation. So hopefully down the road, interest rate will start to normalize, and that will not, central banks will not be that aggressive, because commodity prices actually softened quite a fair bit from where it peaks last year. Now, if you look at CPO seems to be quite interesting in the sense that last year we hit a record high of close to 7,000 ringgit per ton. Then naturally, I think it tapered off because of the rising production and also the stock level. Again, I think the main emphasis is stocks. So prices are very sensitive. So it goes back to your basic economics. When you have high stock levels, which indicate that the supply is coming back and demand is weak, so normally stock levels will have to go up. And with that, you just look at how CPO has actually plummeted quite rapidly from 7,000 region to as low as almost close to 3,000 region. So that within a span of almost 4 to 5 months, which is quite rapid. So now where we are still trading or holding above the 3,000, 3,500 mark, and has been sidelined for quite a period of time. Now, if you compare to pre-pandemic levels, we are still quite elevated. Pre-pandemic levels, the average price is about 2008 to 3004. Right now, we are almost close to average between 3005 to 4000. So I think that's showing you still a bit of tightness in the market. Now, naturally, what will influence prices is basically those factors I mentioned. So what can really drive prices, whether it's going to be another rally that we can see in the CPO market, is going to be down to the supply and demand dynamics. Now, I don't touch too much on economic growth, but what is concerning is that inflation is still a hot theme. It's still a talk among all the central bankers. But I think second half this year is going to be quite jittery in terms of economic growth. If you just look at some of the economic numbers coming from US and China, which is the two very large economy in the world, if they are slowing down, what that tells you about the rest of the world. So with China expecting to slow down even gradual for second half of this year, that tells you a lot where economic projection is going to go or heading towards the end of 2023. Now, ultimately, this will definitely have an impact when it comes to CPO prices, because when you have sluggish economic growth, that will also mean slower demand for CPO. So just going into a bit of fundamental factors. Now, the first thing we always look at when it comes to CPO fundamental factors is always about production. Now, the funny, or rather, not to say funny thing, but if you just observe the production trend for CPO market, you can clearly see that production in Malaysia will start to rise around April onwards, the month of April onwards. Now, what I have in this chart is basically charting at least for the past decade or so when it comes to production pattern for CPO, Malaysia CPO production. So you can clearly see that I think around April onwards, you start to see production start to climb. Now, if you just look at the chart itself, you can clearly see that the production, the rising production will tend to peak around end of October or beginning November. And November, December usually is the two periods where production tend to decline quite rapidly. It's due to, again, these are all seasonal factors, because if you just look at it, December usually is a holiday month. The harvesting cycle is usually shorter because of the many holidays that's involved in the particular month. So having said that, you can clearly see we are right now in a period of rising production. As long as production keep going higher and higher, that will be a concern, because that will push stock levels higher. Now, if you just look at stock level, you can clearly see that we reached the 3 million mark, I think, back in mid of 2019. Then came COVID-19 pandemic. I think that it stifled down a lot of the stock levels. I think right down to below the critical point of 2 million mark. So whenever you see prices trading below, or I mean stock levels hovering below the 2 million mark, that tells you the overall stock level situation in Malaysia is actually very tight. Now, true enough, I think you just look at prices. If you compare prices in 2020 during the height of the COVID-19 pandemic, you notice that actually prices have been trading above the 3,005 or 4,000 level mark. And eventually, I think just last year, middle of last year, you can start to see stock levels start to inch higher. Now, this was the part whereby you start to see CPO prices actually plummeted. So again, I think if you look at CPO prices and stock levels, you can clearly see there's an inverse relationship that's happening. So whenever you have high stock level situation, anything that's above the 2 million mark is considered relatively high in Malaysia. That will really suppress prices. So if you are expecting CPO prices to we really need to see where stock level is going to hit. Now, stock level is the equation of supply and demand. So it really determines on how the supply and demand picture is going to look at whenever you want to look at the stock level. Now, this was just out this morning session. I think Bloomberg just released the estimates for last month's MPOB, which is due to release next week. So you can clearly see, I think a lot of the analysts or forecasts that's being presented is indicating that stock levels is going to inch higher. In fact, I think from where it is probably going to hit over the 2 million mark in the next month, in the next 1 or 2 months or so. If that's the case, we are facing a rising stock level. Prices will definitely be pressured. Now, if you just look at stock levels pattern itself, you can clearly see now we are entering into months or periods where stock levels tends to increase month-to-month basis. Now, if you just look at this chart, this table on the right, you can clearly see those marked by red are month-to-month change negative. and those green are month-to-month change positive. So you can, if just look at seasonality or historically speaking, around June to September period, normally you start to see month-to-month change in or stock levels start to rise quite rapidly, and it start to taper off towards the year end, where you start to see production tend to decline as well. So these are all quite in line with the seasonal pattern when you see in production. But crucially, it's an important element for us to assess the stock level, in the next couple of months or so. Now, going to the demand side, export pace this year has not been fantastic, especially coming from Malaysia. Last year was actually pretty decent. I think last year we saw better growth in terms of export. This year has been actually quite sluggish, I think mainly because of China. If China, like I mentioned earlier, if China starts to slow down, pretty much across the world also start to face the difficulty. So I think true enough, when China starts to slow down, you can clearly see this quite evidently in Malaysia. CPU export is also start to taper off. Now, it's crucially, the thing is that it's not only China is the biggest buyer. India is also one of the largest Malaysia CPU buyer. So the equation is not only on China. We also have to look at India. The good thing about this is that if you just look at numbers coming from India, is slightly better. Now, what I have here is also looking at Indonesia. So just for the audience who are new to the futures market, the palm oil futures market, Malaysia used to be the #1 or the world largest production for palm oil, but I think Indonesia surpassed us back in early 2000. So I think crucially, is it the scenario that is we are looking at in supply and demand dynamics? Is it the same for the world largest producer, which is Indonesia, just across the border? And it's true enough, Indonesia is also facing the same problem like Malaysia, a slower export and a rising stock levels. So it's going to be a market-driven phenomenon. So as long as stock levels are inching higher, it's really going to put pressure on prices going forward. Now, exports in Indonesia is also is slightly better than Malaysia, but if you look at their own trend, if you compare to their relatively trend, you can clearly see that even in Indonesia, we start to see weaknesses as well when it comes to exports. So crucially, I think when it comes to commodities, the biggest commodity consumer is always China. So if China starts to slow down, really, I think that's going to have an impact across all the major commodities. Now, I think the only good side in this is that despite China slowing down, the port levels, the stock levels at the port is still quite relatively very high. So eventually, when consumption pattern starts to increase back, when the economy starts to have a better traction in China, hopefully these stocks levels will start to decrease, and that's a good sign, because when stock levels starts to decrease, that usually tells you, China will come to the market and start buying. Now, India has been aggressively buying, and India is quite a price-sensitive consumer or sensitive buyer. So you notice that India palm oil stock levels at a port has actually been declining quite rapidly, which is a good sign, because as long as stock levels are declining, we take it as a positive sign, because eventually, India buyer will have to come to the market and replenish those stocks, and that will create greater demand for CPO. So I think crucially, if China slow down, India is the next equation that we are looking at, hopefully to absorb some of the decline from China demand. Now, this is a bit concerning in a sense with regards to economic growth, especially from the two biggest economy in the world, US and China. US, when it comes to their economic fundamentals, their economic numbers seems to surprise on the upside. But China, on the other hand, seems to be going down south when it comes to their numbers. So as long as China is not showing you sign of improvement, it's going to have an impact for CPO performance. Keeping in mind, because China itself its economy is large, and when it comes to the CPU market, they are the largest buyer. So if China is going or is heading to a slowdown, that eventually will have an impact for CPU prices. I'm not going to go too deep on what's happening in China, but I think mainly those economic numbers that's coming up from China is not looking good. Whether it's exports or imports, generally they are all showing you signs that are slowing down. Even their manufacturing index is actually showing you a decline. That's also obviously they are fighting off internal economic issue with regards to the property crisis, that's actually property bubble that's actually enveloping, encapsulate the whole economic situation in China. So as long as this economic fog starts to clear down, hopefully we start to see the light at the end of the tunnel for China's economy, and that will probably drive CPO demand in the coming months. Now, looking at other external factors, one of it is looking at ringgit as compared to CPO prices. Now you can clearly see, I think the underperformance of ringgit or the weakness in ringgit did support CPO prices to a certain extent. But keep in mind, there's a period of time where there's a weakness in ringgit also contributed or pretty much in line with weakness in CPO market. So we can't really base on a relationship such as this, whereby whenever you see a weaker ringgit, normally CPO prices will tend to be supported. Keep in mind, there's also other factors, important factors that actually have more of an impact to CPO prices rather than the ringgit relationship. But it's helpful in the sense that right now, if you look at in terms of demand, although demand is weak, hopefully I think with the weakness of ringgit, it will spur some of the whether it's China buying or India buying, because of the weakness in ringgit, it will give a bit of support, which makes that in other words, the CPO price in ringgit is cheaper because of the weakness in ringgit. So hopefully that's the case. And down the road, we start to see, demand starts to pick up. I think that's also an important equation. Now, when it comes to CPO and crude oil, we start to see there's a bit of alignment in a sense that both markets trade quite closely, in a sense that if you have high crude oil price environment, you have stronger crude oil price. Normally, you expect CPO prices also tend to be stronger. So keep in mind, this relationship exists because CPO is also used for biodiesel. You blend diesel with CPO as a way to form biodiesel. Countries like Indonesia, which is a net importer of crude oil, biodiesel policy is important because you have high oil price environment that will create a lot of inflation in their domestic economy. So as a result, they tend to blend CPO together with diesel as a way to save their budget. So in that sense, when a high oil price environment, there's more incentive for people or for producers to go into biofuel market. So high oil price will support CPO prices in return. But nevertheless, when it comes to WTI, we have seen the high and we've seen the low. We have seen just during the peak of the start of the COVID-19 pandemic, for the first time in history, we saw a negative price that's quoted on WTI. So again, I think WTI or the outlook for crude oil is actually very volatile. So in that regards, that may also affect CPO to a certain extent. Now, talking about crude oil, it's also important for us to draw parallel between palm oil and other vegetable oil. And in this sense, it will be the soybean oil market. So clearly, if you have been trading the palm oil market, you probably will take note about the soybean oil performance because both these two products are heavily related in the sense that whenever you trade palm oil, normally you also have to watch out the performance, or you have to observe what is happening in the soybean oil market. Keep in mind, soybean oil market, what happens overnight in the soybean oil market tend to have a spillover effect on the palm oil market the next following trading day. So between these two markets, there's always a spread. The industry always look at both this market as a spread. Now, soybean oil at most times, historically speaking, is trading at a premium compared to palm oil due to various reasons. Now, historically, this premium on average traded about $150 on average. Again, these are all averages. Now, the market has actually been trading way above the average of $150 to the north of about, I think it went to as high as $800 just late of last year. And now I think it's hovering above 300, $350 range, which is quite elevated. So what this tells you in simple sense is that soybean it looks to be quite expensive as compared to palm oil, or in other words, palm oil looks cheap. Now, this will be another important variable that can support or at least give a positive narrative for the palm oil demand story. Keep in mind, you have weaker ringgit and you have a high premium of soybean oil and palm oil. Naturally, a lot of importers will actually gravitate to buying more palm oil because palm oil looks cheap or looks cheaper as compared to other vegetable oil. So I think that's an important equation for us to take note. Now, whether I would recommend looking at this spread and trading based on this spread, cautious. Do take note that both are in different markets, both are quoted in different currencies, so there's a lot of risk to it. But having said that, I think this spread is useful in a sense for us to look at. I think moving forward, as long as this spread remains very high, it's going to be beneficial for palm oil, because palm oil is actually cheaper compared to other vegetable oil. Now, weather is an important element, and it's a factor that is very hard to predict. We can't really predict weather. Even the best weather model can get it wrong nowadays. Whether you can blame it on global warming or whatnot, or climate change, be it. But I think weather is an important factor that will have I think will have dramatic impact for commodity prices in the future. So if you're trading in the CPO market, weather is an important element. Now, if you just look at the current weather report, I think the World Meteorological Organization just released a report, I think probably about last week. It mentioned that there is now 90% probability that El Nino will kick in, and the intensity of El Nino is predicted to be moderate. It's not super strength, it's just a moderate strength. Now, the onset of El Nino, we start to feel it as well. If you just look at the news wire, just yesterday, I think the world recorded one of the hottest day averagely around the world. So it goes to tell you, if weather starts to play nasty, be prepared that you will start to see dramatic swings in prices. Because eventually, when you have bad weather conditions or hot weather conditions, which means it's very dry, it will definitely affect your yield. So that's where weather is an important element whenever you trade commodities like CPO. Now, so I'm just not going to go too deep on what El Nino phenomenon, but generally, I think with El Nino, with the onset of El Nino that's happening, that tells you, countries like us, like Malaysia, Indonesia, and to a certain extent, some parts of India, Central Asia, will really start to see a bit of dryness, because when El Nino tend to be relate to higher higher temperature, higher sea surface temperature, which usually tells you is going to be drier conditions, especially in Asia area. So if you just look at the palm oil belt, at least more than 50% of the global production for palm oil is located in Southeast Asia. So as long as Southeast Asia conditions are going to get drier in the next coming months, so that will have an impact in terms of yield. Now, if you just look at I think estimates by Bloomberg today itself, you can clearly see that a lot of markets are predicting that production trend is going to be quite sluggish, which is quite concerning. If you just look at, historically speaking, we're entering into rising production period, but we don't see that. So that's also another important element. Now, when it comes to prices, how would that impact prices is that, if production is not rising, when especially during the seasonal rising period, that tells you a lot. That means, eventually, I think prices will have to adjust on the upside to reflect this reality that, production may not increase that much, or in fact, production this year may be just a marginal increase. I think that's going to be another ball game differently, which is going to be something for us to take note as we go down the road. Now, if you just look at past price performance when it comes to El Nino weather phenomenon, if you know that if the intensity of El Nino is tend to be moderate, generally we expect price range of the upside between 15% up to the upside of 30%. Now that's a quite big range. Now obviously with a high intensity or what we call super strong El Nino, then that's where price will tend to adjust even more. But generally we expect about 15 to 25 to 30% when you have a moderate intensity of El Nino. Now the strength of the El Nino is still too early to tell, because now we are just in the onset of the El Nino. As we get through the next couple of months, we start to have a better picture as to the development of El Nino as we go forward. Now, I'm not going to go too much on understanding forward curve. I think that explaining this too detailed will probably confuse the audience for those who are not familiar with the forward curve. Now, what this forward curve generally means is that if you just plot the prices for commodities for the CPO contract, especially taking all the 15 contract months and just plot it on a chart, you can clearly see that the performance of the prices in the front month tend to be stronger than a contract that is further down the road. So generally, in this type of market we call a backwardation market. Now, I'm not going to confuse you with the jargon. Basically, when you have strong prices in the near month contracts, that tells you that generally the market is still quite tight. Now, what is concerning is that when those prices between different months starts to become very flat, or the difference becomes narrowed quite substantially, it's going to be quite a concern, because normally in this type of market, if you have a forward curve that's actually quite flat, that only tells you two things: either the market is going to hit into a potential backwardation, or the market is going to hit into a potential contango market. Now, if you have been looking, or you've been observing the calendar spread for some of the major contracts in the CPO market, you notice that most of the spreads actually went into negative spread, which is a bearish scenario, which means that the front month contracts right now is actually trading lower than the forward months. So it goes to tell you that really, I think it's down to the supply situation and stock levels. If the stock levels is expected to continue to be high, that will put pressure on CPO prices. So that's something for us to take note. Again, not to be too bothered by it, but it gives you a sentiment play. At least it gives you how much the view of the market is, especially from market participants. How do they view the next 6 months or so? Right now, you probably will expect the next 6 months or so, if the weather is going to kick in, probably you can see a market heading back in a contango market, which means that the forward contract is going to be trading higher. And the current month looks like it's going to be weak because of the supply situation and the demand story that's actually very weak. Okay, so with that, I think that's cover pretty much on some of the key fundamental factors that one should be observing, or at least taking note of if you are trading the palm oil market. Next, I think crucially is to when you plan for execution and entering a position, it's good to have a plan in place. So a way for me to create a trading plan is to make sure that if you are a trend trader, you use a trend tools. If you are a range trader or a mean reversion trader, you use a mean reversion tools. So I think generally, if you are a trend trader, you want to be observing the overall trend on the market. There's a lot of ways to look at overall trend on the market. One of the ways is to look at it visually. As long as market is creating higher high, higher lows, that generally tells you it's going to be an uptrend market. Or you can always plot a moving averages and just smooth out the lines. If the moving averages is heading higher, that tells you the market is on an uptrend. Now, as a trend trader, there's always a tendency for people. I think generally is what we call market psychology. If you are a trend trader, we tend to, if you see an uptrend, if we miss most of the run, we tend to try to pick where the point of reversal, especially during a trendy market. Now, that's always not a good proposition to begin with. If the market is trending, normally the market will trend quite aggressively. So always keep this in mind. If the market is on the uptrend, try to find positions for you to long rather than finding positions for you to short. Vice versa, if it's a short, if it's a downtrend market, find positions for you to enter a short position. So important for us to take note. Now, obviously, if you are doing into a more shorter time frame, Heiken Ashi is one of great tool to identify trend in the market at a particular time frame, and that will actually eliminate a lot of whipsaws, especially when you look at other type of technical tools. So once you identify using Heiken Ashi, we can always plot it together with moving averages, crossovers as another strategy or parameter for us to make trading decisions. Now, in any execution, it's important for us to make sure that we have a stop loss in place. So there's a lot of ways for us to put stop loss. I'm not going to go discuss all the different ways of it, but I'm just going to discuss a specific way of putting stop loss using an average true range indicator. With that, I think it's also easy for us to manage the stop loss at a given level. Last but not least, I know this part, a lot of young traders or those new to the market, they find it very tedious for us to journal your results, tracing or putting down, jotting down on your trade performance on a daily basis. Now, as a full-time trader, we find this is a very important element. It's not about tools, it's not about strategies at the end of the day, but really about your tracking your performance. So I think journaling is an important element which should not be missed, and is an important criteria when you want to form a trading plan. So looking at trend visually, this is what I meant earlier. So if you look at the highs of the market, is actually quite the same, and the lows are also quite in line. That tells you we are actually in a sideways market. Now, in a sideways market, it is not beneficial for you to use a trend trading strategy. In fact, in these markets, you tend to use mean reversion strategy, that would probably be more helpful. Now, obviously, if the market starts to go into a trend, that's where, if you use a trend trading strategy, will be quite beneficial in that regards. Now, if you just look at it, overall CPO, it's actually been a downtrend for the past couple of weeks or so. But I think just last week, it actually breached the 3,500 mark. Now, it's actually now trading above the 50 period EMA, which is the longer term, and it's now approaching the 200 period EMA line. If it does cross that, that means the market is generally going to be on the uptrend. So right now, the market has actually been consolidating, and right now is potentially heading into a possible rally, as we are seeing in the market. Because I think the 50 period EMA is going to be a very strong support. Once it's breached, it's going to be turned into a very strong support for the market. Now, I'm just comparing you two charts here. Same time frame, same market. Now, if I would ask you this question, whether will you be trading from chart A or chart B? Now, majority of the audience will likely answer that chart B seems to be an easier chart for you to trade. Reason being is because if you just look at the green bars and the red bars, is an indication that the market is either going up or going down. If you just look at chart A, you tend to see a lot of gaps. Now, if you are using gap trading strategy, that may be helpful. But in between those, you start to see a lot of series of red and green candles. Now, in those decisions, you tend to get a lot of whipsaws. So that's where, chart A is normal Japanese candlesticks, and your chart B is actually your Heiken Ashi. Now, there's nothing complicated about Heiken Ashi. It's available on most trading platforms. So what basically Heiken Ashi is basically a tool which is derived from Japanese candlesticks, and it's just taking the average bar of those Japanese candlesticks. So in that sense, if you want to look at trend for a particular period of time or particular time frame, it's easier as compared to Japanese candlesticks. And I think if you talk about understanding the various configuration of candlesticks, Japanese candlesticks is a lot. So I think by using Heiken Ashi, you actually string those down into three simple criteria that you need to know, especially when you use Heiken Ashi. Now, what are those trees? The trees are very simple. As long as you see a green colored bar, that tells you the market is heading for uptrend. If you see a red colored bar, market is going on a downtrend. Importantly, if you see a body that is getting shorter, that tells you the momentum is starting to decline. So if you are holding the uptrend, you're holding the long position, if you start to see candles making smaller body, you have to be careful. That usually means that the momentum is exhausted, and the trend is heading to exhaustion period. So that's where you should be taking position or thinking of a way for you to get out and lock in your profit. Now, if you see upper and lower wick, that also tells you generally the candle bar is very weak. So if in uptrend, there's a series of green bars, and you start to see there's bars creating upper and lower wick, and that's where we really need to be careful as well. Now, if you see a pattern very similar like doji, which is very short body by very long tails, that tells you actually the market is heading sideways, or potentially a reversal in a particular trend. So if you see a series of red and green candles, the market is actually heading to a sideways market. So if you are holding to a long position, if you see a series of red candles starting appearing, that usually tells you it's time for you to get out. Vice versa, you reverse that scenario in a bearish situation. So this will give you how it looks like. You can clearly see this body bars in Heiken Ashi is actually pretty wide. So that tells you in this period of time the market is heading on an uptrend. Now, vice versa, the red candle bars are getting very aggressive. The bodies are getting wider. So that generally tells you the market is actually heading on a downtrend. So it's a simple analysis or interpretation of where the trend of market is at the particular point in time. Now, just another classic example. I think this was taken on past couple of months or so. You can clearly see, the market starts to rally when those green color body bars starts to get wider. And generally, I think the market couldn't sustain. In fact, now the market is heading on a downtrend. So the red color body bars are actually getting very wide. So these are basically a simple tool for you to formulate whenever you're trying to look at a particular trend for the market at a particular point in time. Now, comparing Heiken Ashi and Japanese candlesticks, Heiken Ashi, there's only 3 major forms that you need to know. Japanese candlesticks is pretty much an art concept because there's so many configurations. I think there's more than 100 over combinations. To really master Japanese candlesticks, you really have to put in the time and experience. And again, it's all matter of interpretation. Some may indicate that this is possible. There's a different configuration. Some may look at it differently. So Japanese candlestick is actually quite subjective in nature. Now, Heiken Ashi is very quantitative, that because it's derived from a mathematical formula based on the Japanese candlesticks. So in a sense that you actually can quantify it and you can make an algorithm out of it, and you can automate the trades accordingly. Now, Heiken Ashi is very trend following. So if you are looking at just like color itself, as long as you're holding long position, you should look at the color of the body bar continue to be green. If those body bars starts to turn red, then that's where you need to be careful. Japanese candlesticks tend to be more of a reversal pattern. So when you see a doji or you see a reversal formation, Japanese candlesticks tend to be more of a reversal pattern rather than a continuation pattern. So it's very useful if you're looking at sideways market, you're thinking that a particular momentum is going to break, you can use Japanese candlesticks. Now, another important what sets apart Heiken Ashi and Japanese candlesticks is, if you use Heiken Ashi, you notice there's no gaps. Most of the body bars are covered. So if you are if you're using gap trading strategy, you can't use Heiken Ashi. You have to go back to Japanese candlesticks. So I think that's a major distinction. But overall, as a trend flowing indicator, I think Heiken Ashi does play its role quite well. Now, I'm just going to introduce to you another indicator, which I don't normally use, but I use it as a reference. What we call ADX, average directional indicator, or directional or DMI indicator. They are both. DMI is pretty much the indicator that also involve ADX. Now, what these two indicators seeks to measure is basically the strength of the trend. So ADX, where it goes by value. So as long as a particular trend is in place, the ADX value should go up. Whether it's uptrend or downtrend doesn't matter. So if the ADX value goes up above 20 normally, this is what we call a gauge. That tells you that the market is starting to trend. Whether it's on the upside or downside, it doesn't really matter. Now, obviously, if you just look at the bottom panel here, you have what we call a DMI indicator. So DMI indicator does also include the ADX. So if you just look at it, there's the blue and orange line. The blue is positive, what we call positive directional movement. And the orange is basically negative directional movement. You can study more in detail. You can always Google the function. But what this tells you is that, whenever the negative direction starts to overcome or cross above the positive direction, that tells you market is probably going to hit on the downside. Vice versa, if the positive cross the negative directional movement, that tells you the market is going to hit on a potential upside. So it's useful for us to use ADX to gauge where the market is going to hit and whether the trend, there's still strength in it. So it's a useful indicator to measure strength of a particular trend. Now, so we understand Heiken Ashi. I think Heiken Ashi on its own may not be that effective. One of the ways to also is to plot a moving averages as well. One of the ways is to plot exponential moving average. So one of it is to plot a 9-period moving average, exponential moving average against a 20-period EMA. So one is a shorter term, one is a longer term. So crossovers are easy. As long as the shorter term crosses above the longer term, that means we have a bullish crossover. So we take that in coincide with a positive or rather a green colored body bar on the Heiken Ashi, that could be a very good signal for you to go long. Vice versa, if you start to see a bearish crossover on your EMAs together along with a red Heiken Ashi bars, that's a very good signal for you to take a short position. Okay, so just to show you another example, these are all based on a CPO reference. This will be a very good example to go along because of the green colored body bar and there's a bullish crossover on your EMAs. And this will be a very good position for you to take a short position because there's a red color body bars on a Heiken Ashi, and those color body bars are getting wider. And obviously, we start to see the bearish crossover on your EMEs as well. Now, so just an example of a trading strategy. So here you can clearly get a good signal for you to go to take a position because first thing you have the red color Heiken Ashi bars. That's the body of the bars are getting wider. Secondly, we also start to see there's a crossover for moving averages. We start to see the shorter term crossing below the longer term. So in this sense, we are looking at, potentially a short position because of the bearish crossover on EMAs and the red Heiken Ashi bar. Now, obviously, I did mention in the trading plan, you need to formulate a strategy for you to enter as well as a strategy for you to be getting out of the market in case you are wrong. So one of the ways is that to look at ATR as a tool for us to look at how to measure our stop loss. So this ATR value is 45 at this point in time. So a strategy that we can use is assuming the value of ATR is at 45 and you entered at a price of 3,448. If you work on a reward to risk ratio of 2 to 1, so the target profit should be looking at 90 points, below from your entry price, and your stop loss level will be 45 points above your entry level. Now, keep in mind, as long as the market is within range or what, ATR value tend to be quite stable. But when the market starts to get or gyrate or it goes into a big range market, your ATR value will increase. So naturally, your reward to or your risk measurement will also tend to increase. So keep that in mind. When market gets volatile, you have to adjust the stop loss accordingly. Now, the reason we use ATR is also because setting whether there's a lot of ways for you to set stop loss. But at most times when market is whether it's ranging or it can be volatile period, a lot of people tend to get stop out. So by having a big buffer, it helps you to keep you in the market. Now, obviously, ATR may not be the only rule. You can set yourself for creating stop loss level. You can always obviously add in other parameters or other values or other criteria to it as well. But eventually, I think as a start, ATR can be a good measurement as to how much you want to give a leeway for you to get out of the market, and also the level to take profit. Now, this is just taken today. I thought I just want to reflect because I think today's one is quite interesting in the sense that we saw the crossovers has been consolidating for the whole week last week, and yesterday as well. But today we start to see that there's a bit of weakness when it comes to Heiken Ashi. Heiken Ashi starts to turn red, and also there's a tiny little bearish crossover on your EMAs. Now you can wait for the next 1 or 2 candles to get the confirmation. But then again, it's telling you there's weaknesses in today's price based on the technical reading. Now, if you just look at the DMI indicator as well, you can start to see that the negative DM is actually crossing below your positive DM, which tells you that generally the market is going to hit on a downtrend. And ATR value has actually been quite sideline, which means that the market has actually been trading quite a fair range. On whether it's on a daily basis or whatnot, the market is the range of the market on a daily basis is actually quite on average is doing about 30 to 45 points. So that should be your ATR target as well. So with that in mind, I think it's importantly to consolidate everything, and I think the important part is at the end of your trading day to make sure that you must track your progress by journaling. I think there's oftentimes a lot of traders will tend to forget this part. I think it's important because if you are doing this for a long-term basis, you need to make sure you need to measure yourself, and when you have more data on whether it's on your performance, how good are you doing and whatnot. In other words, you're actually measuring your whether you are progressing when it comes to your overall trading journey. I think that's crucial. It can fit you as a motivation. It can also gives you the insights into what are the areas that you can improve and what are areas that you should be avoiding. So in a way, I think tracking progress is important element when it comes to creating a trading plan, which a lot of traders oftentimes tend to disregard. So just to recap on the 5 techniques, I think crucially, first thing is to look at view things or view perspective of a particular commodity in terms of fundamentals. Now, this can be very tedious. If you are someone that's new to the market, you don't want to be spending so much time, reading reports, understanding data and whatnot. I think crucially, I think if you have not opened an account with Phillip Capital, I believe they do come out with commodity reports on and off. I think that will help you ease a bit of work when it comes to understanding fundamentals. Now, I think the next key thing is look at, first thing is for a trend trader is look at trend. Now, you can look at trend visually, or you can use a technical aids like using moving averages. This will definitely help you when it comes to finding position for you to enter. Heiken Ashi is a great tool when it comes to trend identification. And obviously, you can couple that with ADX or DMI as a trading tool as well. A trend trading tool. Now, setting stop loss is very vital. You can use the average true range as a way to measure your stop loss. Now, keep in mind, when the market gets very volatile, your ATR value will increase, which means that your stop loss level will also have to be increased. So keep that in mind. When the market gets more volatile, you have to be more careful. Last but not least, always journal. Record keeping is something that is people tend to put less emphasis, but I think in my sense of trading world, I think is equally very vital for us to make sure that we have a record keeping in place. So I'm just going to end here with a quote from Alexander Elder. Those who are not familiar who Alexander Elder is, you can always check him out on Google. He's one of the legendary trader. So if you are thinking of creating a path yourself to become a full-time trader, learn the successes of all these great traders. I think there's always something for us. There's always something there for us to pick up. So just let me share this quote with you. The goal of a successful trader is to make the best trades. I think money is secondary. When you have that perspective and mindset, frame it in your mental, I think that's where the probability of success is going to be very high. So with that, I'm just going to end here. I'm just going to hand it over to Brian for any questions from the audience. Brian, over to you.
Hello, can you hear my mic?
Yes.
All right, so that was a very great presentation from David. As expected, he never fails to deliver the good stuff. So we actually have a few questions because we're coming to our Q&A session. So if you have any questions you want to ask David as our speaker tonight, do send them into the question box and then I'll read them out for David to answer. We have the first one, which is today have replay. Yes, this whole session is recorded and will be uploaded to YouTube in a bit. Secondly, we have one which is how to use both fundamental and technical together for execution, because there might be contradicting signals.
Yeah, that's a very good question. Thank you for the question. Now, I think importantly, if you want to trade, there's always oftentimes we encounter whereby fundamentals are telling you, hey, the market should be bullish, but why the technical tools are telling you that the market is pointing downwards, is heading to a downtrend. Now, always believe price is the reflection of both fundamental and technical. So in that regards, you should put more emphasis of on your technical play rather than fundamental. But having said that, fundamental is still vital in a sense that it gives you an element of where the market direction is for the next months or so. Keep in mind, fundamentals tend to evolve very slowly. We just take the weather pattern, for example. El Nino only kicks in 6 months or 8 months effect. It's not an immediate impact. Not having said that, if today suddenly the WMO declare El Nino kicks in, you don't suddenly expect tomorrow's production is going to decline. It will take time. But what this tells you is that in the next 6 to 8 months or so, prices cannot stay where it is as of today. So I think importantly, fundamental gives you a longer perspective. It gives you how you see the market more to the longer term basis. But if you are someone that is trading full-time basis, I think vitally is just look at where prices is at this point in time. and technical is pretty much the forerun in that regard.
All right, that's a very great explanation from David. I have a next one, which is I noticed you use the 30-minute time frame. Any significant advantage over the common 15-minute and 1 hour time frames?
Yeah. Okay. I won't say that is there any common advantage of just using 30 minutes. Now, obviously, what I shared to you, the technical strategy that I share with the audience today, make sure use this as a educational tool. Go back and back test it yourself. Now, the reason is why I use 30 minutes and not higher time frame or lower time frame. Heiken Ashi, if you go down to less than 30 minutes for CPU market, you tend to get a lot of signals. Every 15 minutes by, you tend to get a bullish signal. Then the next 15 minutes, you get a bearish signal. Then what will you do? So you get a lot of conflicting signals, or what we call whipsaw signals. So in that sense, we don't want to use too small or too short a time frame. Now, other markets, it may be useful, but for CPU market, 30 minutes is quite sufficient. In fact, sometimes you can even go to higher time frame to an hour basis. Now, Heiken actually, if you use it on a longer time frame, is actually more useful. But keep in mind, there's also more if your market is heading sideways, whereby it's been trading a tight range like what we see at the past 2 months or so. When you put on a daily time frame basis, you tend to get a lot of whipsaw signals as well, because generally the market overall is actually trading in a side range market. So in that sense, Heiken actually may not be useful. So in a way, we have to also be preemptive in the sense that we must be able to be sensitive to where the market movement is. If the market is heading sideways, don't use Heiken Ashi. Use maybe other mean reversion tools, which is more useful in that sense. So hopefully I answered the question.
Okay, we have next one. It's not a question, but it's thank you, David, for the resourceful information and slides.
Sure, my pleasure.
So the next one is any good free resources or websites to get the FA statistic data?
Okay. So I think firstly is we are very fortunate. We have a very very well resourced data coming from Malaysia Palm Oil Board on every 10th of the month, and also we have other relevant information provider like Malaysia Palm Oil Council. So Malaysia Palm Oil Board and Malaysia Palm Oil Councils, they are the purveyor of this data. So if you want to get data, these are the two sites that normally you go for when it comes to fundamental resources. Now, having said that, as what Brian mentioned earlier on his introduction slides, Phillip Capital also do offer market reports. I think you can obviously look at those reports as well. That will save you time. But I think if you want to look for more detailed resources or more timely resources, I think Malaysia Palm Oil Board and Malaysia Palm Oil Council and also Bursa Malaysia website, they provide a lot of comprehensive resources for you to gather your fundamental data.
All right, we have one more, which is any trading book recommendations.
Okay, the funny thing about this is that I get this a lot. Now, when I start my journey as a prop trader, my mentor always asks us to read a book called One Good Trade. You can obviously go and Google it. It's by Mike Belafore. I think it tells you the journey of a trader. What is needed to be a successful trader. Oftentimes, a lot of us put a lot of emphasis on what is the right tool, right strategy, right methodology. But I would say at the end of the day, this doesn't really matter, because ultimately the mindset that is involved or the thought process that's involved into making these decisions is far more important. And we should put more importance into it. So I'll say, if you look at books, I think One Good Trade is a very good book. Anything that's on trading psychology, like Brett Sdn Bhd and whatnot, there's plenty of resources on YouTube. Those are also very good resources to go for.
All right, we have one more coming, which is how
Sure.
reliable divergence of price and MACD?
Okay. I can't specifically answer that question because I don't have I sometimes I don't measure divergence and track those performance accordingly. But I'll say if you see a setup of a divergence between price and MACD, they tend to be maybe a higher probability trade. But keep in mind, divergence are also very common nowadays. It's a commonality of technical methods. So if you see a divergence in MACD together with price, other people may see it. So whether the market will play out to it, that beats me because again, it's still a probability play. So I think ultimately what we are doing when it comes to technical tools, we are trying to, to make it higher or to, in other words, to raise the probability of success. So I would say, to a certain extent, divergence may be a good play, but keep in mind, divergences are also very common technical tool that also other people are looking at it. So I think that's where we really need to pay attention to as well when it comes to looking at divergences.
All right, so one more is, can I only use technical analysis to day trade full-time FCPO?
Well, this question, I would say you might, but keep in mind, market forces are also very strongly determined by fundamental play. Just take, for example, today, at every 5th of the month, we get estimates from Bloomberg, from Reuters, from analysts. And true enough, why the market came down today is purely because the expectation of stocks level is actually very high. And rising stock levels are in play, which is I shown to you earlier on in my slides. So I would say understanding of fundamental perspective will help you with this kind of degree of understanding the market. But all I'm concerning as a day trader is actually looking at the price. Price is the best reflection for both fundamental and technical. I think that's where we need to be at that point in time.
All right, thank you, David, for answering all the questions. You gave really great explanations, and I'm sure the audience appreciates it. So that is all for our Q&A session. If you wish to contact us, you can find us here at our social media handles. We have YouTube, Facebook, LinkedIn, and Telegram, and Instagram, and our website is linked below here as well. So if you're interested in knowing more of our company, do come to these websites or social media platforms to know more about us. And also, if you're interested in contacting us and get a hold of us, here are our branches. If you are nearby any of these branches or you want to contact any specific one, here are our contact informations. You can screenshot them, or you can also wait for the recording to come out later in the week. All right, so that is all for the presentation. Thank you all for coming, and most importantly, thank you to David for taking his time to explain the slides to us. It was a very informative lecture, kind of like a lecture. It was a very professional, like content-wise. So thank you for coming, and I hope you all have a nice evening. Thank you, David.